You decide what's best for you. Now, today we're going to be learning about trends and trend lines. Now, whether you're trading, investing, or just want to understand finance in general, you have to understand trends and trend lines. Because trends in trading or trends in the charts and trends in finance are no different than trends in cars. We know cars are going to bigger cars and the coupes are phasing out, or we know that the sedans are going away. We also can look at trends and see that red is more popular than blue, and blue is more popular than silver. We can look at women's heels and see that high heels are back in fashion because we can see them trending. Now, in the markets, there's an old adage: trade with the trend, or the trend is your friend until it isn't. So how do we determine the direction of a trend and what a trend is, or if a trend is developing? Wouldn't you want to be trading or investing in something that was going up and steadily moving up? If you look at a chart on gold and you go back to the 1980s, gold has steadily, in a long-term trend, moved up. And even though it may jump up to $2,000 today and down to $1,750 tomorrow and back up to $2,000, still, when you look at it from the 1980s, it has been steadily moving up. In the 1980s, you were paying $300 for an ounce of gold. Today, you're paying somewhere around $1,800. Okay, would that have been a good investment, a long-term investment? Of course it would have been. Now, the question is, how do I determine, or how do you determine whether the direction of a trend? And I believe in the KISS rule: keep it simple, stupid. A trend is simply a way of looking at markets. Now, not just guessing or assuming. Guessing and assuming in the markets can cost you a lot of money. So before we get started, I do want to mention the importance of time frames in determining a trend. And as I mentioned, there's a difference between short-term, medium, and long-term trends. Depends on what you're looking for and what your goals are. Usually when we are analyzing long-term investments, the longer-term time frame dominates the shorter. In other words, if we want to look at putting assets in our retirement package, and we want to look for a particular stock, or we want to look for a commodity like gold or a security, we don't care what it's doing hour by hour. We don't really care what it's doing day by day, because we're looking at putting something away for 10, 20, or 30 years. Do I care that Google bounced up today and then fell back down, or something happened with Facebook that sent the stock down $10 today and it's going to go back up 10? No, I care that for the last 2.5 years, it's been steadily climbing. If I'm looking to invest, if I'm looking to put that asset in my retirement account and hold on to it for a long time, I just want to see what the long-term movement of that asset is. Where if I'm trading, I don't really care what it's been doing over the last 5 years. I care what it's been doing over the last day or two, because I want to buy it at the high and sell it at the low, or sell at the low and buy at the high in a short-term market. So trades can be divided into 3 classes of trading: segments, intraday, and these segments or styles are intraday, the swing, and the position trade. Now, large commercial traders, such as companies setting up productions in foreign countries, might be interested in the fate of a currency over a long period of time, such as months or years. But for speculators, a weekly chart can be accepted as the long term. In other words, many, many, many years ago, 30 years ago, one of my first jobs after I got my MBA was I worked for a company called Crown Zellerbach. They were an international producer of lumber. Now, lumber got sold all over the world. Remember, we're going back over 30 years ago. We didn't have internet, almost 40 years ago. We didn't have internet. We virtually had no computer, so to speak. And we didn't have the euro. We had all the currencies of the Eurozone, and we didn't even really have online trading. Now, my job was to make sure that we had the appropriate amount of currency in the local bank accounts, in the local currency format, to pay for our warehouse. And usually the loads of lumber, we had to pay for it immediately. And my job was to make sure that at the end of the month, we had to pay out $2 million in Swiss francs or Italian lira, that we had that Swiss franc or Italian lira in the bank. It was never a shortage of money, but we also didn't want to be buying the Italian lira when it was very, very high. So my job was speculating what we would need in the lira over the next 3, 4, 5 months. Because see, we also had funds being paid to us in lira. And it was a matter of speculating how much we would need to be buying in the lira, getting it at the best price of the lira, so that when it came time to pay those bills, even if it might be 60 or 90 days from now, we weren't overpaying and we could actually make money on the currency move. Because we were large commercial traders that were using the funds for other things. Then we have, short-term goals. Somebody who might need to pay a bill today, and they're going to, they know they're getting something from China and they have to pay in, well, it used to be always US dollars, and you were in London, you needed to know you had to have dollars when that container landed on the 14th because you had to pay the Chinese in dollars only. But you didn't want to buy that when the pound was high, but you didn't do that much business. But you would look at the price of the pound over the week before, because if you could trade your pound for the dollar early enough, that would offset the interest charge of doing that transaction early, you might consider doing that. And then, of course, we have short-term traders or online Forex traders who don't really care whether the pound is going up or down today or yesterday. They only care that it surged up today and they could sell at a high price and buy back. They're only concerned with short term. But ultimately, the goal here is to determine the trend direction, not when to enter or exit a trade. Of course, this is not to say that there are no trading opportunities in shorter time frames, such as daily and hourly charts. But for those traders who want to trade with the trend rather than trading the correction, one could wait for the trend to resume and again trade in the direction of the trend. Because a trending market is one in which price is generally moving in one direction. Sure, price may go against the trend every now and then, but looking at the longer term time frames would show that those were just retracements in shorter term intervals. Now, trends are usually noted by higher highs and higher lows in an uptrend. In a downtrend, they're noted by lower highs and lower lows. Now, there's not very specific rules to picking a trend or saying we actually have a trend. Now, the markets can only move one of three ways. They can move up, they can move down, or they could be sideways chopping or congesting, that whole little mess. And most of the time, the markets are a mess. They're moving all over the place. They're not moving up, they're not moving down. Because the markets are random. And if you follow my philosophy that the price of an asset is random, that the markets are random because the prices are made up of human beings, human psychology, human nature, and they're all over the place. But there are certain times when the price of an asset starts exhibiting non-random behavior, and this non-random behavior can be known as trends. When we can see those trends, whether they're short-term, medium-term, or long-term, we can then apply rules and analysis and make decisions because something is being non-random at the moment. Now, as I mentioned, there are three types of trends: uptrends, downtrends, and sideways or horizontal, or the mess that we get. Now, some chartists consider that a sideways trend is actually not a trend on its own. It's just a lack of a well-defined trend in either direction. Some call it congestion. Some call it resting. I call it noise or a mess. And that's how the markets usually are. But as we can see here on my chart, we could have a longer term uptrend with in between a short term downtrends, and then within there a medium term trend. Now, depending on where we wanted to invest, if we were looking to invest for a longer term, we would be looking at this trend. Yeah, that might have helped us a little bit. We might want to say, well, we should have gotten that up here. But ultimately, when we're deciding how much profit we make, okay, when we're looking at longer term investments, we're looking at overall, the stock market will pay 8 to 12% annual returns in the long term. Now, sure, if you got in here and happened to get out here, which was 3 years later, you might have gotten a huge return. But on the whole, you're not looking to guess. You're looking for your asset to continually going up. A medium-term trend trader might look here. A short-term trader, like a day trader, would look in this, and he would want to trade, sell here to get out of the market here. So he would be shorting. So would a guy up here be shorting? Okay. So along with 3 trends direction, there are 3 trend classifications that have to do with time duration in which a trend is taking place. A trend of any direction can be classified as a long-term trend, an intermediate-term trend, or a short-term trend. For Forex trading, a long-term trend is comprised of several intermediate trends. The short-term trends are components of both major and intermediary terms. You can actually have within a trend movement many short-term and medium-term trends in there that as a long-term investor you never see and don't care about, whereas a day trader or short-term investor, they're very important to you. Now, how would we notice or see these on a chart besides just using our eyeballs? And using our eyeballs, this would we could see an upward movement, but we couldn't actually see a trend. Well, one of the best ways to take the noise out of the markets is by using something called a moving average. A moving average cleans up this noise. Now, again, a longer period moving average tells us more about the trend. So if we want to look at a long-term investment strategy, we want to look at maybe a 100-day moving average. If we're looking at a short-term trend, we may want to look at a 7 or 20 period moving average. But it helps takes the noise out of the markets and help us to see whether a market is trending. And in this case, when we combine 3 moving averages and they're all 3 moving up, we know we have a strong long-term trend. Then we have things like Bollinger Bands that help us see uptrends and downtrends visually on our charts. And then we have looking at waves. Now, the belief is a trending market moves in waves. There's Elliott wave theory, there's Gann theory, there's all types of theories out there. But the overall prevalence is that markets move in 3 waves up and 3 waves down. And it's possible to use this to gauge your trend. Now, the way I try to explain it is that when you have a hamster in a cage and he gets on his little wheel in that cage and he starts turning around and around and around, okay, he's starting either an uptrend or a downtrend, depending on which way he's running. That wheel picks up momentum and motion. Okay. When he gets tired out or wants some water and he goes to slow down, it's going to take a while to slow down because a move gathers its own momentum, a trend. And once that momentum is gathered, it's hard to just stop that trend dead flat. Not saying it can't happen, but you'll usually see that trend losing momentum or losing its pace or starting to look different. So as the hamster's running and running, he gets in the cage, just jumps on his wheel. All of a sudden, his little legs start turning that wheel, and as the wheel turns faster and faster, it's easier and easier for him to run forever. Then when he decides he wants some water and he can't jump off, he's got to slow down a little bit. But the wheel's going slow. Sooner or later, it's going to lose its momentum. And at some point, he'll be able to get off that wheel. But understanding wave theory and the direction of trends can help you judge the market. By counting the waves or the pivots in each wave, one can attempt to anticipate whether a trading opportunity will be against a trend or with the trend. According to Elliott wave theory, an impulse wave consists of 5 swings and a corrective wave consists of 3 swings. In other words, 5 moves up, 3 moves down. But it's not straight moves up. It's what we call push, ease. push, ease, push, ease. So we can say here that the traders or the investors or something brought people's interest into Amazon. Okay. People started jumping in the market on Amazon. The press started running and they pushed up here. Well, those guys who got in down here said, you know what, I'm going to start taking some of my profit. The other guys who were saying, reading other articles and wanting to jump in said, oh, you know what, I think it's pushed up too high. I should have gotten it. And all they do is move to the sidelines. They don't sell, they don't move in. What happens is it loses a little bit of its momentum. Well, at some given point, which is higher than the beginning point, all of these traders come back in the market. These guys say, now it's cheap enough for me to buy it. These guys over here say, I already booked my profit, but it's low enough again. I'm going to take another run at it. And they jump in the market. Well, now both of them are in their feet first, and they push the market up. And each one of those are swings or pushes and eaves, pushes and eases. So sometimes the market will not cooperate with these technical assumptions, but it can occur often enough to provide some very lucrative trading opportunities. So in other words, if we would have looked at the opportunities afforded us, now if we were an investor looking to buy something to hold on, this from August 4th to September 8th, October 6th, November the 3rd, December to January. So we're talking about 1, 2, 3, 4, 5, 6 months. Okay. A trader would have jumped in here, watched it go down here, seen this ease of momentum, traded to go up, then could trade it to go down, you could have traded to go up in each one of these waves. Where an investor would have looked to enter the market here by selling low, and he would have let it run, and he would have been very happy. He didn't care about this and that, this and that. So a lot of that's determined by determining what type of a trader you may be. But by combining moving average diagnosis with pivot point count and then fine-tuning the analysis with the observation of, say, candlestick patterns, a trader or investor can stack the odds of making successful trades in their favor. Remember, trading is a craft, which means that it is both an art and a science and requires practice to develop consistency and profitability. So one of the easiest, most reliable ways to make money in Forex trading is to follow trends and let winning trades run for as long as they will. When you trade like this, the most of your trades are small losing trades. But sooner or later, they are more than paid for by the few huge winners. It takes some discipline to trade like this, but it's easy. You don't need to be a genius and even very experienced or knowledgeable to profitably trade in this style. You do need, of course, is at least one trend to exploit. When the Forex market is very flat and trends are completely absent, trend traders cannot avoid losing money while they want to participate. So identifying trends becomes vital. Hold on a second. Let me pop up some live charts so you can actually see. Now, this is the pound. This is a live chart. This is the pound as of, well, this is a 1 week chart. So each one of these candles represents a week. But we can see a beautiful longer term trend for the pound. Remember, the pound crashed after Brexit, never recovered much. But then it got hit really hard with a stronger dollar as, you know, the UK got hit worse and worse with the virus and all the other problems they had. Well, now we can see over the long term, since the beginning of 2020, this steady, beautiful uptrend. Okay, if you were looking to invest in the pound, this might have made a nice investment. If we are a medium or short-term trader, we don't see it as clear in a shorter term time frame. But we might have been able at some point to enter the markets here and trade to here. This was all sideways mess in what we were looking at. But then we can see a short-term trend that developed here. Now, when we're looking at trading as opposed to investing, there are rules that we want to use because we have to get something based on rules. And so these moves up and down, besides being trends up and down, can become what we call trend lines. And to draw a trend line on your chart, you have certain rules in which you need to follow, because there's a difference between being an upward trend or a trending market and when you actually want to actually enter a market and do something in a market. And you need some type of rules so you're not just guessing. Because we have all types of reversals, mean reversions. We have the market psychology that's going on. We have all bunch of stuff happening here in the market. And we have all these human beings driving us crazy. So what we need to have is some rules. And we get these rules with what's called trend lines. The identification of patterns and trends are techniques used by analysts studying supply and demand of an asset traded on the open market. A trend is a general direction of price over a time period. A pattern is a set of data that follows a recognizable form, which analysts then attempt to find in the current data. Analysts use trend lines and channels, which are essentially boundaries on price fluctuation, in an attempt to spot and define trends. Uptrends are characterized by an asset price hitting a series of higher highs and higher lows, while downtrend patterns are marked by lower lows and lower highs. There are a number of analytic tools that can be used, and using trend lines can present a clear picture of trends in your business or in trading by connecting a number of points on a chart. What is revealed is a possible downturn or uptrend in the direction of the group of values identified by the data. Understanding how to use trend lines can help reveal what might happen in the future. Trend lines represent a charting technique, which a line is added to represent the trend of a currency pair or asset. Drawing a trend line is as simple as drawing a straight line that follows a general trend. Trend lines can be used to identify trend reversals. Trend lines are a useful tool for visually highlighting a trend and potentially being part of a trading strategy. There are lots of mis and inaccurate information about trend lines, though, so learning how to use them effectively is important. Now, trend lines are a technical analysis tool used to define and project price trends in major markets such as stocks, forex, and futures. Trend lines have a potential to alert us when a pullback is over and the trend is resuming, or when price and the trend is accelerating or reversing. So as you can see, an upward trend, which you saw on this chart, is drawn underneath price, where a downtrend is drawn over price. So during an uptrend, we see this progress of higher swing highs and higher swing lows. When the price creates a lower swing high or a lower swing low, the trend is in potential jeopardy. During a downtrend, it's just the opposite. Pullbacks within a larger trend, such as a pullback on a weekly chart, can often appear as trends on a shorter time frame, such as a daily or hourly chart. Even on a daily chart, there are small waves within larger waves. Understanding the basic concepts of price action is crucial because it applies to every trend we trade. If trading with a trend, we want to see this type of movement, higher highs and higher lows. Now, the rule starts out with any time there are two highs or two lows, you can draw a trend line. That sounds pretty simple. It means you could draw a line all over your charts. Okay, that would be ridiculous. The trend line is drawn by connecting one high to the next or one low to the next. When starting out, draw as many trend lines as possible in all directions. This helps differentiate pullbacks and short-term trends. Now, what makes it different is a trend line no matter what two numbers you're attaching, can have no price breaking that line. So in other words, if any price breaks through that line, you have to redraw your trend that it will always keep, in an uptrend, keep those prices above. So trend lines are not only based on price, but also have a time element. This creates a great myth. Traders are often say that because a trend line is broken, the trend is over. That is not true. The price could break through a trend line just because it looks longer for a wave to complete. But we still have to draw the new trend line. Trend lines are not only based on price, but also on time. So in this example, we can see prices moving up. We have this trend line, but then price broke through it here. Okay. That trend line, not the trend, but this trend line is no longer valid. And we would have to draw a new trend line on, incorporating that price and keeping that price over. Well, when we see we originally drew this trend, now when we just attach 2 points to that line, it doesn't tell us much. Like I said, we can attach 2 points to any line. We could have had here and there. We need a third touch of that price point to validate that trend. So in other words, when we drew this trend line and projected it into the future, those 2 points, those 2 touches right here, hadn't validated that trend line. We have to wait into the future till it gets valid. When we have that third touch, that becomes a valid trend line. And then we could have actually traded price to move up. And we could have made quite a bit of money here. So trend lines will often need to be redrawn. They are not a perfect trading tool that tell you exactly where the trend will reverse. You will draw your trend line connecting highs or lows only to see that the next price wave doesn't match up with just the trend line exactly. So you now must decide if you want to redraw your trend line to accommodate those misalignments. So the very first thing to know about drawing a trend line is that you need at least 2 points in the market to start a trend line. Once the second swing high or swing low is identified, you can draw your trend line. So there are 3 very important keys to drawing a trend line. The higher time frames will always produce the most reliable trend lines. Most trend lines will have some overlap from the high to the low of the candle. Never try to force a trend line to fit. The goal of every trader is to buy low and sell high within a current price trend. Trend lines give us a way to identify the high and low ranges of the trend. As an example, if we are looking to buy a currency based on fundamental view and it's pulling back to the uptrend line, this gives us an area to buy the currency at a low price in the current trend. The exact same is true in a downtrend. If we were looking to sell a currency based on our fundamental view and it's pulling back to the downtrend line, we now have an area to sell the currency at a high price in the current trend. So using trends, understanding trends, and then learning how to draw trend lines is very fundamental in investing, short-term, medium-term, and long-term trading. Okay, and it's just part of the financial markets. You should be able to talk wisely on any asset or any market. And by understanding how to look at a chart or price movement and define the trend and make smart assessments based on that trend, you'll be one step farther ahead in the markets. So thank you very much for joining us today, and we'll see you in our next class. Bye now.